From the Center for Agricultural Profitability at the University of Nebraska-Lincoln, this is Nebraska Farmcast. I'm Ryan Evans, and with me today is Tina Barrett from Nebraska Farm Business Incorporated. Nebraska Farm Business Inc. works with hundreds of Nebraska producers to provide financial analysis, business planning, and tax preparation. And Tina's here with me to help explain a new tax law that could impact many agricultural operations across Nebraska. Earlier this year, the Nebraska Legislature passed LB 754, which contains changes allowing partnerships and S-corps to elect to pay state income taxes at the entity level rather than only at the owner level. This opens up potential federal tax benefits for pass-through entities that were previously only available to C-corps in Nebraska. The law also includes options to make this election retroactively from 2018 to 2022. So Tina will discuss how this new approach works, who might benefit from it, and what business owners should consider if debating whether to make this election. Tina, thanks for joining me.
Thanks for having me.
So can you first provide just a brief overview of what this new law does and what motivated the legislature to pass it?
Yeah, so this is a law that's becoming pretty common in most states. In fact, we were one of the last 7 states in the country to pass this. So it's new to Nebraska, but it's not necessarily new all around the country. But where this has come from is when the federal government passed the Tax Cuts and Jobs Act back in 2017, there was a limit placed on the amount of state income taxes that could be deducted. That was one of the pay for features. So if you itemized prior to 2018, you could deduct your state income tax. After 2018, you can only deduct up to $10,000 of your state and local taxes. And so for a lot of higher income individuals, especially from states with higher tax rates, that was a huge hit to their federal tax bill. And so what a lot of the states have done is come up with this kind of a workaround to allow people to continue to deduct their state income taxes on the federal side. This won't affect the Nebraska budget or your Nebraska return bottom line. You're still going to pay the same amount of tax to Nebraska. So it's just a matter of trying to work around that federal tax law that was passed.
And what do you see right now as some of the main pros and cons that business owners should consider as they decide whether to make this election to have their pass-through entity pay the state income taxes?
Yeah, well, like I said, this is new to Nebraska, but not new around the country. So we have a little bit of experience to draw from other states. While everybody's pass-through entity tax law is a little bit different, the general idea is obviously the same. So one of the things that we've seen from other states who have done this is that there aren't too many cons to this, but there are some situations where business owners wouldn't want to necessarily make this election. And it will be an annual election, so you can make this decision for one year and not for others. The biggest downsides to maybe when we're not going to want to do this is when you're having losses, which makes sense because you're not paying tax anyway. When you're changing ownership, and again, maybe in the farming world, that's not such a big deal unless it's unrelated owners changes. So, I mean, if we're switching from a father to a son, maybe we don't care about the tax quite as much as if it was, a neighbor situation, something like that. So those kinds of things. But for most operations, this is going to be something that they're probably going to want to elect to do.
Okay, and when it comes to the administrative side of this, how complex and time-consuming will the actual election process be?
That's a good question. And so one of the things that Nebraska passed a lot of income tax changes for what normally we don't see very many on the state level, and there was quite a few fairly significant changes that were passed this year. So we have not seen anything from the tax commissioner or from the Department of Revenue as to how exactly this is going to be done. And so that's something that, we're going to have to wait a little bit to see exactly how Nebraska is going to handle it. What we're kind of expecting is that for 2023, we'll make that election on the 23 return, and we'll have the ability to do that. I don't think on an ongoing basis this is going to be very complex. There's just going to be some timing issues with the entities paying estimated taxes and things like that, because we do know that they will not have the farmer exemption of waiting until the end of the year to pay the taxes after 2023. But the complex and time-consuming part might be the retroactive piece. As far as I know, Colorado is the only other state that has passed this retroactively, so that we can go back to 2018 and start to make claims on those years. That's kind of unprecedented, which it's really nice that Nebraska gave it to us. It could be a huge deduction coming forward. But how that's going to be done and how we're going to have to administer that is still unknown. It could be as complicated as having to amend 4 years tax returns for every owner or shareholder of the entity. And so for complex ownership structures, that could be a lot of tax returns. It could be much simpler than that. We're just going to have to wait and see.
And you described some situations when it may make sense or not make so much sense for folks to make this election. But what about for those considering forming a new entity under this law? What factors should they consider before making the move?
I think that's going to be the question is for those who are not farming in an S Corp or partnership, should we be or should we have one now? Again, that's going to be a really specific question for your operation. I mean, it could be things like, moving from a Schedule F as a joint venture with a husband and wife getting 2 payment limitations, moving to an S Corp with 1 payment limitation might be enough to say, we don't want to take advantage of this tax credit because of what we might give up in the FSA office. Or there's certainly a ton of other factors that go into whether or not you should have an entity. And so this is just going to be one more consideration. And so for sure, anybody who's thinking that maybe we need to change something, that we want to talk with your tax advisor and your advisory team to make sure that this is the right move for the whole of the operation and not just to take advantage of this one potential tax savings.
And you've got an article about this up on our Center for Ag Profitability's website at cap.unl.edu. It's also linked to in the description, the podcast notes here that listeners can find, where in that article you provide a great example of how this could impact taxes. So can you just walk through for listeners an example of how this might work for a small business owner, what the potential savings might be?
I use an example of a partnership with $150,000 worth of income. So the state tax on that kind of income would be about $10,000. So in the past, the individuals pay that tax. And what this would do is the entity, the partnership, would actually pay that $10,000. And then the individual's K-1s would have a credit for that. But what we're going to get is that the year that $10,000 is paid, we now have a federal tax deduction for it. Again, it's an add back on the state, so it doesn't affect the state return at all. But it's going to lower your federal taxable income from 150 to about 140. And so then that deduction or that lower income is what's going to pass through to the individual owner's returns. And so then it's going to depend on your federal tax bracket, which could be anywhere from 0 to 36% of that $10,000. So if you're at the highest brackets, you're maybe thinking of this, and your income is in the partnership is about 150. The federal tax savings might be 3,000 or 4,000. So again, it's not huge, but it's one thing that, again, especially if the entities are already in place, that we can take advantage and save a little bit more money.
And do you have any other advice that you might give to business owners who are unsure about whether to make this election right now, advice as they evaluate the decision?
Yep. So patience is probably going to be the biggest advice right now, because your tax preparer can't know anything because the state hasn't released anything. But we can start thinking big picture about what this might look like and how that goes forward. But it's going to be things like thinking through, again, how estimated tax payments are going to be made. It's also going to be an impact for Nebraska resident owners. If this is their only income, they no longer have to file a Nebraska return if you make this. So that in itself would save those shareholders money from a tax preparation standpoint of not having to file a Nebraska return. So there's a lot of benefits out there that are going to be very specific to your operation. So certainly, the best thing you can do is just make sure you have a conversation with your tax preparer about that this fall when you're doing tax planning. And then again in the spring as you're getting the tax return prepared, and making that decision together as to how to move forward.
Very good. That is Tina Barrett from Nebraska Farm Business Incorporated. And for more about this new pass-through entity tax bill in the state, you can visit our website, cap.unl.edu, for a look at the new article that Tina has written on this issue. Thanks very much, Tina. Nebraska Farmcast is a production of the Center for Agricultural Profitability at the University of Nebraska-Lincoln. For the latest research-based information and education resources to manage your farm or ranch operation, visit our website at cap.unl.edu. That's cap.unl.edu.